Welcome to the deep dive. Have you been watching the AI space lately? I mean, it feels like every week there's news about companies building the infrastructure,
Yeah.
the actual backbone that makes all this incredible AI stuff possible.
It really is like a new gold rush, isn't it? Everyone wants a piece of the action.
Exactly. So, that's our focus today. We're digging into a big question about one player that's growing incredibly fast, right in the thick of it, and already backed by some pretty big names. Is Nebius Group NV a genuine investment opportunity right now, or is it maybe a highly speculative bet?
That's the million-dollar question, or maybe billion-dollar given the valuations these days.
Huh, right. And just so you know how we're approaching this deep dive, it's all based on this really detailed analysis report you provided us. It's fascinating stuff. By the way, if you're a Stock Analytics AI member that's at the Euro 4.99 a month level, you can actually give them a ticker, and they'll prioritize a deep dive just like this one for you, focusing on analysis, earnings insights, tailored for what you're interested in.
Yeah, and applying a focused lens, like, say, value investing principles, think Warren Buffett style, to a company in such a, well, hyper-growth, hyped market like AI infrastructure, it can really cut through the noise.
It really can. Sometimes it yields some surprisingly clear insights.
Exactly.
And that's really the mission today,
Right.
to unpack this report, which looks at Nebius Group NV, ticker NBIS, through that rigorous value investing framework. We're basically going to walk through the report's key findings chapter by chapter, pulling out what's most important for you to understand right now.
Yeah, the goal is to get to the heart of what makes NBIS tick, especially given where they sit in the market. I mean, as of, what was it, May 23, 2025, the company had a market cap around $9.22 billion.
$9.22 billion, trading at 38.73 cents per share. That valuation, yeah, that's something we'll definitely keep coming back to.
For sure.
And we will revisit that first question, opportunity or risk, right at the very end, armed with the report's conclusions. So make sure you're subscribed to this deep dive feed. You really don't want to miss unpacking these complex topics.
Definitely worth sticking around for the verdict.
All right, let's jump in. We'll start with the first half, really getting a solid handle on the business itself, the management team, and the raw financial health.
Sounds good. So the report kicks off by helping us understand the business. Nebius Group, NBIS. It isn't a brand new startup exactly, but it is a pretty new standalone company.
Right, it spun off from Yandex NV that finished up in August 2024, and they're based in Amsterdam.
Exactly. So it has some history, but it's operating as its own distinct thing now. And its core strategic focus is, well, it's laser sharp, building and providing what they call full stack infrastructure, specifically for the global AI industry.
Full stack. Okay, so when they say full stack, you mean everything, like from the ground up.
Pretty much. The AI-centric cloud platform itself, owning and running these huge data centers packed with high-performance GPUs, and then building the software and tools on top.
Ah, right. So trying to control that whole vertical hardware, software, tools. I remember the CEO, Arkady Voloz, the Yandex co-founder.
Yeah.
He had this quote about having rebuilt everything from scratch, but we are not starting from scratch.
Yeah, that quote really nails it, doesn't it?
It does, that dual nature. They're new, but they kept, over 850 engineers and a tech foundation from Yandex.
Exactly. They've got experienced talent, they've got technology, but the corporate structure, the focus, the path forward, that's all brand new. Their business model is, well, pretty standard for infrastructure and platform services, direct contracts, subscriptions for platform access, licensing for their tech.
Makes sense.
And the report breaks the company into 4 segments. But it's really clear the core AI infrastructure, that's Nebius AI, is the star of the show. That's the main revenue engine.
Okay, let's break those down. Nebius AI specifically. What is that?
Nebius AI is their core. It's the flagship segment. This is the AI-centric cloud platform built for those really intense AI and machine learning workloads. It gives access to those huge GPU clusters, all the developer tools needed. This is the part showing just, well, explosive growth.
Got it. And then there's Toloka AI. I've heard of that one.
Yes, Toloka AI. It's a platform focused on data generation and labeling, super crucial for training AI models. Now, what's interesting here is they recently got a strategic investment led by Bezos Expeditions.
Bezos Expeditions. Wow. Okay.
Yeah, and as a result, Nebius deconsolidated. Toloka.
Deconsolidated. Okay, break that down. What does that mean financially for Nebius?
It basically means Toloka's full financial results aren't merged line by line into Nebius's main income statement anymore. But, and this is really key, Nebius still keeps a significant majority economic interest.
Ah.
The idea is that the separate path lets Toloka scale faster, chase its own growth, while Nebius still benefits financially from its success through that ownership stake.
Okay, so they still get the economic upside, but it's not part of the main company P&L day-to-day. Makes sense for focus. What about the other two, Triple 10 and Override?
Right. Triple 10 is an edtech platform focusing on STEM and tech careers, reskilling. And Ride is working on autonomous vehicle tech, think delivery robots, ride-hailing stuff.
Those seem, well, pretty different from building giant AI clouds.
They absolutely are. And the report definitely highlights that management views these Triple 10 of Ride and also their minority stake in ClickHouse.
Oh, yeah, the database company. Fast one.
That's the one. They see all these as non-core assets. The strategy seems to be to potentially monetize them later, sell off stakes to fund the big expansion of the core AI business.
Ah, okay. So they're kind of like potential piggy banks for the main AI push.
Yeah.
Got it. Let's drill down on that core Nebius AI platform then. What are the actual products and services driving all this growth?
Well, the absolute critical piece is access to GPU clusters. They provide access to high-performance NVIDIA GPUs, the H100, the H200, and they plan to have the next-gen Blackwell series in 2025.
Right. In the AI race, having access to the newest, fastest hardware.
Yeah.
That's everything. It's like having the fastest car when everyone else is stuck in traffic.
Exactly right. It's a massive advantage. They also really emphasize their proprietary technology. They claim they've got this in-house cloud software architecture, custom hardware design for servers, racks, data center layouts.
So vertical integration, aiming for performance and efficiency tailored for AI.
That's the goal. But, this level of vertical integration, it comes with a hefty price tag, massive R&D. The report notes that their product development expenses were, wait for it, 72% of revenue in Q1 2025.
72%.
Yeah.
Of revenue just on R&D.
Uh-huh.
In one quarter. Wow. What does that number really tell us about their strategy right now?
Well, it's a pretty stark illustration of their all-in bet, right? They're betting on proprietary tech to stand out. It's probably necessary if they want to compete head-to-head with giants like AWS or Azure, who have, equally massive R&D budgets, if not bigger. But it also means profitability is, well, it's a long, long way off. Costs are just incredibly high, even with revenue growing like crazy.
That paints a very clear picture.
Okay.
They're also offering managed services and tools, yeah.
Yes, things like Nebius AI Studio for easy self-service AI inference and a full MLOps suite to manage the whole AI development lifecycle. They launched something like 50 new products and features in Q1 2025 alone.
50. In one quarter. That pace is just intense.
It really is. It shows the speed they're operating at.
Okay, now, you mentioned NVIDIA before. The report makes a really big deal about the NVIDIA partnership. How deep does that actually go?
This is where it gets really interesting, I think. NVIDIA isn't just a supplier here. They're an actual investor in Nebius.
Oh, wow. NVIDIA put money in.
Yep. Plus, Nebius is a launch partner for NVIDIA's Blackwell Ultra platform. And get this, it's one of only 5 NVIDIA cloud partners globally.
One of just 5.
Okay.
That gives them incredible early access to those GPUs that are so hard to get, right? The cutting-edge stuff.
Absolutely. It's a cornerstone of their competitive position. It's crucial for attracting those customers who absolutely need the latest and greatest hardware now.
Makes sense. Geographically, where are they operating?
They've got R&D hubs scattered around Europe, North America, Israel. Their data centers are currently in Finland and France.
They're expanding aggressively, especially here in the U.S., right? I saw something about that.
Very much so. They brought a new cluster online in Kansas City just in April 2025. And there's a build-to-suit facility in New Jersey that's expected late summer 2025. Plus, they're involved in building Israel's national AI supercomputer.
The sheer scale they're aiming for, it's kind of mind-boggling.
It really is. They're targeting deploying over 100 megawatts of data center capacity just in 2025.
100 megawatts.
Yeah. And their potential pipeline could exceed 1 gigawatt in the medium term. To give you some perspective, a gigawatt is roughly the capacity of a large nuclear power plant.
Wow. Okay. Building that kind of capacity, basically these small cities of AI power that takes absolutely massive capital investment, which, again, brings us right back to the money side.
Exactly. It all comes back to the funding.
Okay, so we've got the business. AI-focused, full-stack infrastructure These non-core assets potentially funding things leaning hard on proprietary tech and that critical NVIDIA partnership. Let's move on to the people running this show. What's the report say about management?
Well, the key figure, as we mentioned, is the CEO, Arkady Veloz. He's got a really impressive track record, right?
Yeah.
Co-founder of Yandex, led it for 25 years, successful NASDAQ IPO, peak market cap of $31 billion.
Yeah, that's a serious resume. Proven history of scaling a major tech company. That's a definite plus.
Definitely. He's a serial entrepreneur, technical background, and he's personally leading this rebuild effort, bringing that core team of over 850 engineers with him from Yandex.
Okay, what about the rest of the leadership team?
There's a team of key execs in place, CFO, COO, and so on. They actually have a new CFO, Maria Delgado Alonso Sanchez, starting June 1st, 2025. The report does note the average tenure is quite short, maybe 0.8 years.
Right.
Which is totally understandable, given it's a recent spinoff. It's essentially a new team forming under a very experienced leader.
Now let's talk about something that really impacts investors like you listening. The corporate governance structure. They're incorporated in the Netherlands.
Yes, under Dutch law. They've got the standard stuff, public governance documents, committees, ethics code. But the critical thing the report really zooms in on is the multi-class share system.
Ah, yes. This is where voting power gets raised.
It's getting right.
Precisely. You've got Class A shares with 1 vote each. That's what most public investors hold. Then there are Class B shares with 10 votes each, held by insiders. And Class C shares for technical reasons. The absolute key point is that the Lastar Trust, which is linked to CEO Arkady Veloz, holds roughly 12.9% of the economic ownership.
Only 12.9% economic stake.
But controls a dominant 55% of the voting power. 55% voting control. Okay. So, for you, the minority investor holding Class A shares, this means the founder effectively has control over major decisions. Things like electing directors, approving big transactions. Your vote doesn't really swing things.
Exactly. Now, Veloz's significant economic stake does align his financial interests with creating value for all shareholders. He wants the stock to go up, too. But his voting control gives him the ultimate say on how that value is pursued and key governance matters. There are independent directors providing oversight, but they operate within that structure.
And this dominant control ties right into their capital allocation strategy, doesn't it? It explains how they can pursue this complex plan.
It absolutely does. The strategy is clearly driven by this focus. Aggressive, massive investment in that core AI infrastructure growth, and this enormous investment is being funded from their existing cash balance and, crucially, the planned monetization of non-core assets.
Okay, this reliance on selling other parts of the business to fund the main engine. It seems really central and, frankly, kind of complex.
It really is. They are investing heavily. We talked about the scale. CapEx in Q1 2025 alone was $544 million.
$544 million in one quarter.
Yeah. And their full year 2025 CapEx guidance is around $2 billion. That was actually increased from $1.5 billion previously. Just for context, FY 2024 CapEx was $808.1 million. And don't forget that huge R&D expense, 72% of Q1 revenue. That's also part of this big investment push.
So where does the money for that $2 billion CapEx target for this year, plus all that R&D come from, besides the cash they already had?
That's where the asset monetization plan becomes absolutely critical. They plan to sell stakes in these non-core holdings. Take their roughly 28% minority economic stake in ClickHouse. Recent reports are valuing ClickHouse around $6 billion.
$6 billion.
Yeah, which could potentially mean Nebius' stake is worth somewhere around $1.68 billion.
$1.68 billion. Okay, that's a very substantial potential funding source. That covers a big chunk of the CapEx.
It certainly could. They also kept that significant majority economic interest in Toloka AI after the deconsolidation, so that has value. And they're exploring strategic investments or partnerships for Avri. The report notes they currently don't plan dividends or share buybacks. Everything is focused on plowing money back into growth.
Makes sense for a growth company.
They do hold treasury shares, which could potentially be used for future financing if needed, maybe acquisitions or just shoring up the balance sheet. It adds another layer to the funding picture.
Given all this heavy spending, their return on invested capital, ROIC, must be, well, deep in the red right now.
Oh, yeah. Significantly negative. The report points to figures in the range of negative 7.93% to maybe negative 11%. That's pretty standard in this kind of intense build-out phase.
Right.
Achieving a positive, attractive ROIC, that's going to require not just hitting their ambitious medium-term targets like those 20-30% EBIT margins on, mid-single-digit billions in revenue scale, but doing it on this rapidly expanding, very expensive capital base. It's definitely a multi-year journey.
Okay, we've got the structure, the plan, the management. Let's look at Chapter 3, the financial health. How do the actual numbers reflect all this activity?
Looking at the historical performance, say FY 2023 and FY 2024, you really see that story. Hypergrowth married with significant losses. FY 2024 revenue hit $117.5 million. That was a massive 462% increase from $20.9 million in FY 2023.
462% revenue growth. That's staggering.
It's definitely eye-catching, no doubt. But alongside that, the net loss from continuing operations actually widened to $396.9 million in FY 2024. That's up from $336.6 million the year before.
So growing fast but losing more money on a GAAP basis.
Right. Now, adjusted EBITDA loss, it's a measure looking more at operational profitability before things like depreciation and interest that actually narrowed slightly in FY 2024 to $266.4 million. Cash flow from operations was negative, burning through $319.6 million in FY 2024, and CapEx was also high at $808.1 million.
So massive growth, still burning cash from operations, still spending heavily on CapEx. They ended FY 2024 with $2.45 billion in cash, helped by a $700 million capital raise, right?
That raise was definitely crucial. Now, looking at the most recent numbers from Q1 2025, the trends mostly continue. Revenue was $55.3 million, still up a huge 385% year-over-year from Q1 2024.
Still very strong top-line momentum.
Yes, and their core infrastructure annualized run rate revenue, or ARR, basically what they'd earn if that quarterly rate continued for a full year, was running at about $310 million in April 2025.
Okay.
And here's a positive sign. The gross margin improved significantly in Q1 2025. It hit 46.7% compared to just 22% in Q1 2024.
Oh, that's a big jump. That suggests the actual economics of selling their AI infrastructure are getting better as they scale up.
Exactly. It's good news for the underlying business model profitability potential. However, total operating expenses remained incredibly high. $184.8 million, which was 334% of revenue in Q1.
334%. Wow.
Yeah. Product development, as we said, 72%, and SG&A sales, general and admin costs were 120% of revenue. So this resulted in an operating loss of $129.5 million and a net loss from continuing operations of $113.6 million.
So the GAAP net loss number is still widening year over year for the quarter.
Correct. But the adjusted EBITDA loss did narrow again to $62.6 million compared to $70.9 million in Q1 2024.
Okay, so that adjusted measure is moving in the right direction at least.
Yes. And a really crucial point from management guidance was their expectation to achieve positive consolidated adjusted EBITDA in the second half of 2025.
Or the whole company.
Yes. And possibly even for the core AI business alone, maybe in Q3 2025.
Yeah.
If they hit that, it would be a very significant milestone.
Definitely something to watch.
Yeah.
What about the balance sheet? How does that cash position look now after that heavy Q1 spending?
Well, as of March 31st, 2025, they still had a substantial cash pile, $1.44 billion. But, and this is really important, that's down $1.01 billion just from the $2.45 billion they had at the end of 2024.
$1.01 billion. Burnt in just one quarter. Let's just pause on that. That is a serious burn rate.
It really is. It starkly highlights the capital intensity of their expansion plans. On the asset side, property and equipment, reflecting those data center investments, grew to $1.33 billion from $847 million at year-end 2024.
So the asset base is growing.
It is. They have minimal financial debt, which is good low debt-to-equity ratio, around 0.09, and their liquidity ratios look very strong on the surface. Current ratio around 18, quick ratio around 15.7.
So they have plenty of readily available assets compared to their short-term debts and very little traditional borrowing.
Exactly. They are very liquid right now. But that rapid cash depletion over $1 billion gone in 3 months, it really underscores the funding needs for that $2 billion CapEx plan this year, plus covering their ongoing operational losses.
Right.
The funding for that massive CapEx heavily hinges on, 1, improving operational cash flow, hopefully turning positive soon, and 2, the successful execution of those non-core asset sales we keep mentioning.
So those asset sales aren't just for some abstract future growth. They seem pretty necessary to help fund the spending plan for this year, 2025.
That appears to be the case based on the current burn rate and the scale of the CapEx targets. In terms of profitability and returns, well, as we've established, they are currently unprofitable across all standard metrics. Net margin, ROE, ROIC, that's expected in this phase.
Right, the investment phase.
The improving gross margin, that 46.7% in Q1, is definitely a positive sign. But achieving those medium-term targets of 20–30% EBIT margins, that will require significant operating leverage. I mean, revenue needs to grow much faster than costs and very high utilization rates on all that expensive GPU capacity they're installing.
What about owner earnings, that concept value investors like? The actual cash flow available to owners after necessary reinvestment. Is that even calculable here?
That's really difficult, almost impractical to calculate meaningfully for Nebius right now. Buffett's idea is about the surplus cash the business generates after putting back what's needed just to maintain its competitive position, its existing operations.
Yeah.
Nebius isn't just maintaining, it's building a whole new engine from scratch. It's currently a massive capital consumer, not a generator of surplus cash. Most, if not all, of their CapEx is pure growth spending, not maintenance. Owner earnings only become a relevant, useful metric once a company achieves sustained profitability and its capital needs stabilize relative to its revenue base.
Makes perfect sense. They're still deep in the factory building stage, not yet cranking out widgets and counting the profit. What about revenue quality? Who are these hundreds of customers?
The report notes their primary customers right now are AI-native startups. Now, while these startups are driving a lot of the current AI demand, they can also be more volatile financially than large, established enterprises.
Yeah, less stable.
Yeah. They do have hundreds of customers, which provides some diversification, but the strategy to target more enterprise clients is important for long-term predictability and revenue stability, although that usually involves longer, more complex sales cycles.
Okay, that gives us a really good picture of the business, the management, the financial situation based on the report. Let's switch gears now for the second half. Let's look at the market surrounding NBIS, who owns it, the really key risks involved, and finally the big conclusion the report draws.
Right. Let's dive into market sentiment, Chapter 4. As we said, May 23, 2025, stock price $38.73, giving a market cap around $9.22 billion.
So what does that valuation imply about the market's expectations? What do the key metrics tell us?
Well, the key metrics show, let's just say, a very high valuation. The price-to-sales ratio, PS, based on their trailing 12 months revenue, that FY 2024 number of $117.05, is around 78.5x.
It's any gate.
Yeah.
0.5 times sales. Okay,
Yeah.
that's an astronomical multiple.
It really is. It clearly signals that the market is pricing in extremely high future growth expectations, just massive optimism about their execution and market opportunity. The price-to-book ratio is more moderate, maybe around 2.9x.
Yeah.
Enterprise value to sales, TTM, is also very high, around 66.2x. And price to earnings, of course, isn't applicable because they're currently unprofitable.
What about analyst sentiment? Are the Wall Street analysts bullish too, matching that high valuation?
Generally, yes. The consensus rating you often see cited is a strong buy based on coverage from, I think, 3 analysts as of late May. The average one-year price targets seem to range from maybe $50 up to $56.10.
So suggesting significant upside from the current $38 level within the next year.
Exactly. Forecasts stretch from maybe $47 up to $63. For instance, D.A. Davidson has a $50 target. Northland Capital Markets initiated with an outperform and a $56.10 target. So analysts are definitely focused on that growth momentum and expect the stock to appreciate in the near term. But remember, these 12-month targets are different from a long-term intrinsic value assessment.
Good point. Who are some of the major institutional holders? Any interesting names on the list?
Well, based on filings around the end of Q1 2025, some notable holders include Orbis Allen Gray. They had about 6.6%. Of course, the Lastar Trust linked to Veloz with that 12.9% economic stake, but 55% voting power. Then you have Slate Path Capital at 2.5%. They notably increased their position recently.
Oh, interesting.
Citadel Advisors, 1.9%, also increased. Invesco at 1.5% increased. On the other side, some like Fred Alger Management, 1.3%, and Greenwood's Asset Management, 0.9%, decreased their holdings. Morgan Stanley was another one that significantly increased their stake, holding about 0.9%.
So some big names moving in, some trimming. And we talked about NVIDIA earlier. They're on this list too, right, as an owner?
Yes, absolutely. NVIDIA Corporation holds about a 0.5% stake, which they acquired through that private placement back in December 2024. Their holding is particularly noteworthy, not because it's huge, but because it really underscores that crucial strategic partnership. It aligns interests beyond just the simple customer-supplier relationship.
Yeah, that makes sense.
Wait. Changes in these institutional holdings can definitely signal market sentiment shifts, but as always, their reasons for buying or selling can vary widely.
Let's spend just a bit more time on the ownership structure in Chapter 5, really reinforcing that multi-class share system we touched on earlier. It seems critical.
Right. It's absolutely critical to hammer this home. You've got Class A shares with 1 vote, Class B with 10 votes for insiders, Class C with 9 votes. And the absolute key takeaway for you as a potential investor is that Arkady Veloz, through that last R trust, controls 55% of the total voting power,
55%.
despite holding only 12.9% of the economic ownership.
Okay, so let's be really clear. While his financial interests are aligned with yours on the stock going up, he essentially calls all the important shots: strategy, board composition, major deals, regardless of how you or other minority shareholders vote.
Exactly. This concentration of control allows for decisive, potentially long-term strategic moves driven by the founder's vision. That can be a positive. But it inherently limits the power and influence of minority shareholders when it comes to governance matters.
Right.
And as the report highlights, this structure directly impacts that whole capital allocation strategy we discussed. That complex plan to fund the core capital-intensive AI business by selling off parts of those non-core assets, ClickHouse to Loka Everyday, that's ultimately under his control and depends on his execution.
And if those asset sales hit a snag, if they don't get the value expected or they're delayed.
Well, if the planned monetizations don't happen on time or at the valuations they need, Nebius could face funding gaps for that huge $2 billion annual CapEx program. This would likely force them to seek external financing, probably issuing more stock, which would very likely dilute existing shareholders like you.
So the success of this intricate capital recycling plan, driven by that controlling interest, is itself a key financial risk factor to watch closely.
Absolutely. It adds a layer of financial complexity and execution risk.
Risk. Okay, that's the perfect segue into Chapter 6. Understanding the risks is just paramount for any investment decision, but maybe especially for a company like Nebius, operating in a super fast, capital-hungry sector, relatively new as a standalone entity. What are the key risks the report really flags?
The report lays out a pretty multifaceted risk landscape. First up, there are significant business and operational risks. Execution risk is high on the list. Undertaking rapid global expansion, building these massive complex data centers in new regions like the US and Israel, that's incredibly difficult and carries real risks of delays, cost overruns, just operational headaches.
And the competition is just brutal, right? Competitive pressures must be intense.
Oh, absolutely intense. They're facing off against the hyperscalers, AWS, Azure, GCP, who have, vast resources, established customer bases, huge ecosystems. Plus, you've got these specialized AI cloud providers like CoreWeave, Lambda Labs, Oracle Cloud Infrastructure, OCI. They're also well-funded and growing super fast.
Yeah, it's a crowded field.
It is. Differentiating yourself and capturing significant market share in that environment is a major challenge.
And the tech itself changes so fast. Technological obsolescence has got to be a constant worry.
For sure. The AI hardware and software landscape evolves at lightning speed. Their proprietary tech requires constant heavy R&D just to stay relevant, and the NVIDIA GPUs they rely on get updated every year or two. They have to keep investing just to keep up. Success is also heavily tied to reliance on key personnel, primarily CEO Arkady Veloz and that core engineering talent he brought over.
We mentioned their customer base earlier, too. That customer concentration and volatility with the AI-native startups, that's another risk factor.
Yes, startups, while driving demand now, can be less financially stable, more volatile than large enterprise clients. That adds uncertainty to revenue streams. And finally, just operating as a new standalone entity means facing post-divestment challenges, setting up independent systems, building a market identity completely separate from Yandex.
Okay, those cover the operational and competitive hurdles. What about the pure financial risks?
Well, the most immediate and maybe most concerning is the high cash burn and funding requirements. We saw that $1.01 billion decrease in cash in just Q1. Due to the high CapEx, that $2 billion planned for 2025, and the ongoing operational losses, they have significant negative free cash flow. Their cash reserves, while still large, are being depleted very rapidly.
And that links directly back to the uncertain path to profitability.
It absolutely does. While management is targeting that positive adjusted EBITDA in the second half of 2025 and those medium-term 20-30% EBIT margins, Actually achieving those targets depends heavily on successful execution, favorable market conditions, tight cost control. It's far from guaranteed. And failure to reach profitability just exacerbates those funding pressures.
Which brings us back again to the reliance on asset monetization.
Exactly. They're a whole strategy to fund this massive growth spurt, partly through selling stakes in ClickHouse to Loca of Rede. It introduces significant uncertainty regarding the timing and, crucially, the valuation they can get for those assets. Delays or shortfalls would likely create funding gaps, pushing them towards external financing and potential dilution for existing shareholders like you.
Okay. What about market risks? It's a hot sector, but that can cut both ways.
Precisely. Stock price volatility is definitely high. It's a high beta stock in a very in-favor hype sector, so it's prone to big swings based on broader market sentiment towards AI, interest rates, you name it. Investor sentiment itself is a huge risk factor here. Well, that current sky-high valuation is heavily dependent on continued positive sentiment, continued enthusiasm for AI infrastructure generally, and for Nebius's growth story specifically. Any significant shift in that sentiment could lead to sharp price corrections, regardless of the company's underlying progress. And that ties directly into the high valuation risk. Those incredible multiples, like 78.5x price to sales, mean highly optimistic scenarios are already fully baked into the current stock price.
No room for error.
Pretty much. Any failure to meet these lofty expectations, slower growth, missed profitability targets, execution stumbles, could result in significant stock price declines because there's just no margin of safety built in at this valuation.
What about regulatory and legal risks? AI governance is a hot topic globally.
True. They face risks from evolving AI governance. Think the EU AI Act, various U.S. state laws. Navigating this complex, changing landscape means compliance costs and potential fines if they get it wrong. Data privacy and security are obviously paramount when you're handling potentially vast amounts of sensitive training data. They need robust compliance with laws like GDPR and strong security measures, and their international operations expose them to varied legal, tax, and labor laws across different countries, plus potential geopolitical uncertainties, maybe even lingering scrutiny related to their historical ties to Yandex.
Okay, let's zoom in on one specific risk the report called out: the potential impact of U.S. tariffs planned for 2025. Can you break down that risk for us?
Yeah, this is a material-specific risk highlighted in the report. New U.S. tariffs are being considered or potentially implemented on semiconductor manufacturing equipment and, critically for Nebius, data center hardware components, servers, networking gear, storage, all the stuff they need to buy in huge quantities. These tariffs could range anywhere from 10% to 25%, maybe even higher, on these essential items.
Okay, how could that directly impact Nebius, especially with their big U.S. expansion plans?
It would directly increase their capital expenditures significantly, especially for those new U.S. data centers they're building out in Kansas City and New Jersey. Industry analysis cited in the report suggests these kinds of tariffs could add maybe 12% to 18% to the hardware setup costs. One estimate mentioned was for every $1 rise in a chip price due to tariffs, the overall server cost could rise by $3.
Ouch. That makes their already expensive expansion even more costly.
Exactly. It makes it significantly more expensive. It could also lead to margin compression if they can't pass these increased hardware costs fully on to their customers because the market is so competitive, their own profit margins will suffer.
What did Nebius management say about this on their earnings call? Did they address it?
They did. In the Q1 2025 call, management stated they don't anticipate a significant impact from the current tariff environment, but they acknowledged they are monitoring it closely.
But the report notes a potential discrepancy there. Suggests maybe the impact could be bigger.
It does. It points out that broader industry analyses generally suggest these tariffs could have a more substantial cost impact for any company building out data centers in the U.S. This raises a fairer question for you, the investor, to consider. Is management's current view perhaps a bit too optimistic, or does Nebius genuinely have specific sourcing strategies, maybe bulk purchasing agreements or timing advantages, that truly mitigate the impact for them?
Right.
The report concludes that if these tariffs escalate further or are enforced more strictly than currently anticipated, the financial strain on Nebius could indeed be more material than management currently suggests. It could potentially accelerate that cash burn even faster and increase the pressure to either raise external funding or successfully execute those asset sales sooner rather than later. It's definitely a specific risk factor that deserves careful monitoring going forward.
Okay, that gives us a really comprehensive picture of the multifaceted risks involved here. Now let's bring it all together. Chapter 7. The conclusion. And the big reveal of the report's overall perspective, what's the summary? What's the investment conclusion from this deep dive report?
Okay, so the report concludes that Nebius Group NV is, without a doubt, a compelling growth story. They're operating within the very promising, rapidly expanding AI infrastructure market. They have a strong, seasoned leader in Arkady Veloz. They have that crucial strategic partnership with NVIDIA, and they are demonstrating undeniably impressive, hyper revenue growth, all positives.
As we said up front, we're looking at this through a specific lens, a value investing lens. What's the conclusion from that perspective, according to the report?
Right. Through that disciplined value investing lens, the report suggests NBIS currently warrants extreme caution. Why? Well, first, the business itself, while focused on AI infra, involves complex technology, multiple segments, and this really intricate financial structure heavily reliant on future asset sales. That makes it challenging for an outside investor to fully grasp all the nuances and risks.
Okay.
Second, while the market prospects for AI infrastructure are clearly excellent long-term, Nebius' ability to build a truly durable, independent economic moat, a lasting competitive advantage, is still uncertain and seems partially reliant on maintaining that special NVIDIA relationship. Third, management has a strong track record, but that multi-class share structure significantly limits minority shareholder influence on key decisions, and the complex strategy of funding growth through asset sales carries significant execution risk.
And the elephant in the room, the valuation.
Exactly. Most importantly, the report concludes that at the current market price, that $38.73 as of late May, there appears to be very little, if any, margin of safety. Those extremely high valuation multiples, like the 78.5x price to sales, effectively price in highly optimistic future growth scenarios and assume near-perfect execution across the board.
Leaving almost no room for error, for setbacks, delays, increased competition, or unexpected costs, like those potential tariffs hitting harder than expected.
Precisely. The report suggests that the value based on current assets, even if you try to factor in the potential future value of those non-core assets they might sell, is likely significantly below the current market price.
Okay, so let's circle back to our initial hook question. Based on the analysis in this report, where does Nebius Group NV land right now? Is it that genuine opportunity, or is it the highly speculative bet?
Based on the analysis provided in the report, as of May 24, 2025, Nebius Group NV appears to be a highly speculative growth investment rather than a compelling value opportunity based on traditional value investing principles.
Right. The report suggests the risks stemming from that sky-high valuation, the current lack of profitability, the heavy reliance on future events like asset sales for crucial funding, and the significant execution challenges in this incredibly competitive, capital-intensive market. These risks seem substantial relative to the potential reward at this specific price point.
It's a fascinating company, absolutely. It's in a hot, high-potential market, showing truly impressive, raw growth numbers. But the report really highlights that the price being paid today demands near-perfect execution and assumes a very, very optimistic future unfolds smoothly. From a value perspective, that lands it squarely in the high-risk, speculative growth category right now. It's currently in a show-me phase.
A show-me phase. I like that. They need to demonstrate they can actually translate that rapid revenue growth into sustainable profitability, generate positive free cash flow, solidify their competitive advantages beyond just the NVIDIA partnership, and successfully execute that complex financial strategy, including monetizing those non-core assets effectively.
Exactly. Key things to watch would be progress towards those profitability milestones, positive adjusted EBITDA in 2H 2025, those medium-term EBIT margins.
Right.
Also, the success and timing of the non-core asset sales, continued customer adoption and diversification beyond startups, and of course, the actual impact of those U.S. tariffs on their cost structure.
Fascinating indeed. So Nebius Group, growing incredibly fast in a market everyone is watching closely. But this deep dive into the report really underscores that its current valuation, combined with the execution risks and the complex funding structure, makes it look much more like a speculative growth opportunity than a traditional value play at this moment.
The potential is certainly tangible, you can see the vision, but the price today assumes they clear every single hurdle almost perfectly.
So here's a final thought for you, our listener, to consider and maybe mull over. Does the undeniable explosive growth potential of the AI infrastructure market truly justify paying these current sky-high valuation multiples for NBIS and taking on the significant execution, competitive, and financial risks outlined in the report? Or perhaps might a patient investor prefer to wait for more tangible evidence of sustainable profitability, a clearer path to self-funding before diving in at these levels? Something to think about. If you found this deep dive valuable and want more analysis like this, be sure to head over to YouTube and find and subscribe to Stock Analytics AI. They put out great content.
Research and AI disclaimer.